Hello, I'm Gaurav Sharma. I'm an independent oil market analyst and a columnist for Forbes. Today we're here to discuss the direction of the oil market and what a time it is to discuss such a subject given the geopolitical tension that we're seeing in the Middle East, the trade wars that seem to be near perennially lurk on the horizon since Donald Trump got into the White House, and of course the various macroeconomic permutations that we have. Now let's just jump straight away to the geopolitical tension that we've seen right now. I think overnight we heard that the Saudis claimed 2 of their oil tankers had been sabotaged. Now this morning we wake up that there were some planned attacks on the onshore installations. So now what's happened is that intraday we've had a near 1% jump in the oil price, and of course overnight a lot of people were hoping for some signs where the geopolitical tension would sort of reflect in the futures price of Brent in West Texas. And that did not turn out to be the case for one simple reason, is that the trade wars that Donald Trump is threatening, not just for the Chinese but in general, is creating such an overhang that it is neutralizing the bullish factor being geopolitics and the bearish factor being the prospect of a prolonged trade war between the US and China, and that dragging everybody else. So it's acting as a bit of a counterbalance. There is some uptick after today's geopolitical infraction in the Middle East, but I think the key thing to note here is that if we rewind the clock back to sort of 2012, 2013, prior to the American shale barrels coming onto the market, you've probably seen a $5 or $10 uptick almost in a space of 48 hours. Now the geopolitics is pretty tense. It's highly doubtful, I mean you can never discount stupidity, but it's highly doubtful that the Iranians would want to start a regional war, despite what the situation might well be. But even if you were there, you would have seen a $4 or $5 premium in the old days, i.e. 2012, 2013. The reason we're not seeing them right now is because the United States is now a buffer producer and is incrementally pumping barrels of light crude, and the direction of the cargo is eastwards, and the nature of the crude is getting lighter, and there are more and more American barrels. Even though the last sort of Platts survey revealed that Saudi Arabia was pumping less, the United States production keeps going up and up, and a lot of people believe, a lot of analysts in the market, myself including, believe that 11 million barrels per day in US production, which has already made the United States the largest producer in the world, is highly likely. So when a buffer producer is in town, then the geopolitical impact is neutered. And of course the Trump White House is as apolitical to, or shall I say, appears disinterested in sort of global geopolitics if we compare it to the stance taken by the Obama regime. So A, the States has its own barrels of light crude. B, it's not as interventionist as it would have been in the Bush or the Obama years. And what that means is that the Americans will be less interfering. The chances of a war, despite the rhetoric, is pretty low. So you have the trade overhang, a German slowdown, Brexit, all sorts of macroeconomic permutations weighing on the price. And that is precisely why each time Brent sort of lurks towards $75 a barrel, or the West Texas threatens to touch 65, it is dragged right down by the macroeconomic corrections that we are seeing in the market. For the spread bettors, for the punters out there in the market, I think the wise thing to do is to play on a daily news basis. So examine the news flow, have a flutter on that news flow between a 300 points spread either side. So I would say my still end of the year price would be Brent averaging about 75 and West Texas averaging around in the range of $65 a barrel. Thank you.